Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. In today's weekly briefing, we bring you a slew of updates on what is driving inflation and its broader implications on banking, ASEAN equities, and rotation to quality stocks over value. We also look into the dramatic rise in digital banking in the Philippines and how the Malaysian automotive sector will perform once the sales and service tax is removed after June. Winson, head of fixed income research, discusses with our analysts.
Hi, good morning everyone. It's 8 o'clock on Monday. A quick recap for last week. The global risk sentiment improved. Both equity and bond prices rebounded. The S&P 500 index jumped 6.4% last week. Both the Eurostock 50 and Hang Seng indices were up by about 3%. But in ASEAN, the performance was mixed. Singapore, Thailand, and Indonesia indices were up by about 1% on average, while Malaysia and Philippines declined by 1 to 2%. On fixed income, developed market sovereign yields were broadly lower, led by the UK gilt and German bund, with their 10-year yields falling 30 bp. The US high-yield corporate spreads have stabilized, but remain wide at more than 500 bp. A number of Fed officials last week voiced their support for another 75 bp hike at the next FOMC meeting in July. Chair Powell, in his testimony to a US Senate committee, said that achieving a soft landing in the economy could be very challenging and acknowledged that a US recession is a possibility. On central bank meetings, last week we have the Philippines BSP hike rate by 25 bp, but Bank Indonesia maintained its policy rate at 3.5%. And later we have Suhaimi and Joy to comment on this. On inflation, the UK CPI hit a 40-year high at 9.1% in May. The Bank of England warned that it could actually get worse, rising above 11% in October. Singapore government announced a 1.5 billion support package to help certain vulnerable groups. And Malaysia also made a similar announcement with a package worth more than 600 million, giving out cash assistance to the B40 group. A tentative good news, I think, for inflation is that global commodity prices have fallen quite sharply, on average down by about 10% over the past 2 weeks, which is the largest decline since March 2022. For example, Brent crude prices down about 7%. Metal prices like aluminium, copper, nickel, and iron ore down by about 10 to 20%. And even agriculture commodity like corn, soybeans, and wheat have been down by about 7 to 15% in the past 2 weeks. And some updates on China. The Omicron wave has come under control. Shanghai reported zero new COVID infection last Saturday for the first time since March. There are signs of stabilization in the Chinese economy and manufacturing activity rebounded, but consumption remains weak in China and there are still concerns about the property sector. And last week, we have the Country Garden, which is one of the largest developers in China. Their rating was downgraded by Moody's from borderline investment grade to junk rating. Looking ahead this week, on the key economic events to watch out for, we have PMI indices for a number of ASEAN countries and China, and also Indonesia CPI on Friday. And this morning, we have Suhaimi and Joy to update us on economic data. Desmond on Malaysia banks, Rachel on Philippines banks, Anand on ASEAN equity strategy, Jacqui on Philippines equities, Han on portfolio strategy, and TJ on Malaysia automotive sector. And let's start with Suhaimi. Suhaimi, Malaysia inflation released last Friday. The headline CPI went up further to 2.8% year on year. What caused the increase, and do you see any signs of inflation broadening? And I noticed you have revised up the headline CPI forecast for both 2022 and 2023. Can you share what are the key reasons?
Good morning, Winson and everyone. The pickup in headline inflation rate last month to 2.8% from 2.3% in April. First and foremost was ahead of our consensus estimate of around 2.5% to 2.6%, largely due to the rise in food and non-alcoholic beverages cost, which rose to 5.2% in May from 4.1% in April. Bear in mind also, there's partly due to seasonal demand effect as well, due to the Ramadan and Eid in April and May. There is also the inflationary impact of pent-up discretionary spending and services demand from economic opening, as reflected by the increase in prices and costs at restaurants, hotels, and recreation services. And I think signaling the spread of inflation to other items, core inflation rate pick up to 2.4% in May. That's the highest since July 2017, from 2.1% in April. So we revised upwards our 2022 and 2023 inflation rate forecast. For this year, we're looking at 3.4% now, from 2.7% previously. For next year, we are looking at 4.1% versus 2.5% respectively. This is because, number one, we incorporate higher prices of essential food items like chicken and cooking oil prices starting next month, following the soon-to-be announced higher ceiling price for chicken, as well as the announced removal of selected cooking oil price subsidies. We also factor in assumption of fuel price subsidy review next year. As we know, the government announced removals of ceiling prices for, or revision in ceiling prices for chicken, as well as removal of price subsidies for cooking oil in the between 2 to 5 kilogram bottles effective next month, but maintain the subsidy for cooking oil in 1 kilogram poly bag, priced at RM2.50 per packet. So our revised 2022-2023 inflation rate forecast assumed, among others, for example, the unsubsidized 5 kilogram bottle cooking oil price of around 40 ringgit from around 30 ringgit prior to the lifting of the subsidies. We're also looking at a revised ceiling price for chicken of around 12 ringgit per kilo from a previous ceiling price of 8 ringgit 90 cent per kilo. And for next year's assumption on fuel subsidy review, we think this will, or we assume this will lead to a 25% increase in RON 95 and diesel prices in 2023. But to mitigate the cost of living impact from the mainly food and fuel inflation between now until end of next year, the government has also announced some measures like, for example, the decision not to hike power and water tariffs in Peninsular Malaysia for at least second half of this year.
And on Philippines, the central bank raised policy rate by another 25 bp. I think it's in line with yours and market expectation. Is the BSP still under pressure to hike rate, and how much more do you expect for this and next year?
Yep, BSP raised policy interest rate by 25 bps last week to 2.5%. This is after the 25 basis point hike last month. In a way, BSP has signaled that, and BSP also, I think, has guided for another increase in August. I think the main thing to also highlight here is BSP raised its inflation rate forecast for this year to 5% from 4.6% previously. And for next year, they also bumped it up to 4.2% from 3.9%. I guess with inflation rate projected to be above BSP targets of 2% to 4%, we pricing in another 50 basis point rate hikes to 3% by the end of this year, and also looking at another 100 basis point increase to 4% in 2023.
Thanks, Suhaimi. Let's move to Joye on Singapore economics and Indonesia rate decision. And Joye, let's start with Singapore. Last week also, the inflation number accelerated. I think core inflation went up to 3.6%, which is the fastest since December 2008. And you have revised up both the headline and core CPI forecast for 2022. And why is inflation pressure still high, and any thoughts when it will start to ease?
Hi, good morning, Winson. Good morning, everyone. So core inflation is rising, and we are seeing broad increases across most categories. Food prices rose by 4.5% in May, and services costs are also rising on more expensive holiday expenses and point-to-point transport services. Our utility costs are also inching up with higher prices of electricity plans offered by open electricity market providers. Headline inflation rose by 5.6% in May. It's also surging because of higher petrol costs, COE premiums, as well as housing rents. We raised our inflation forecast for both core CPI to 3.2 and headline CPI to 5.1% to account for the stronger than expected price pressures. The tight labor market risks fanning a wage price spiral. We have seen average monthly wages rising by almost 8% in the first quarter, compared to 7% in the fourth quarter of last year. And some share of this rising cost may be passed on to consumers. As Winson mentioned earlier, the government announced a 1.5 billion support package for lower income and more vulnerable groups. Another step that the government is taking is raising the core funding share of wage increases for lower income workers from 50% to 75%. And that could help to partly offset the risk of a wage price spiral. We are looking at core inflation to peak in the third quarter. Commodity prices have been coming down from the recent peaks, including food prices, and the relaxation on some export restrictions on palm oil by Indonesia and fertilizer by Russia will help ease some of these food price pressures. Yeah, stop there.
Still on Singapore, there was the industrial production data released last week. What are the key takeaways and any change to our GDP forecast?
Yeah, so manufacturing growth in May actually came in much faster than our expectations, came in at 14% growth. And this was really being driven by semiconductor production levels, which climbed to another record high, surging by 46% because of strong global demand from 5G markets as well as data centers. But besides semiconductors, the broader growth momentum is clearly slowing. In fact, if we stripped out semiconductors, manufacturing actually fell by 1.5% in May. This stronger than expected performance in semiconductors will provide some lift to second quarter GDP. We expect it to come in at around 3.5 to 4%, extending the 3.7% growth in the first quarter. I just want to highlight that chip production is more resilient than our previous expectations. Even with disruptions from China's lockdowns and slowing global growth, Singapore's chip manufacturing is faring well. And some of the big chip makers are expanding capacity in Singapore. Global Foundries announced that a new plant will be on track to be operational next year. And Micron intends to invest more than $150 billion globally over the next decade. And Singapore will probably be a beneficiary as well.
On Indonesia, the central bank kept the policy rate unchanged at 3.5%. I think it's against our expectation of a hike. What do you think is holding back the Bank Indonesia, and when we see almost every regional central bank kind of like have started the tightening cycle, or at least signal a strong intention to do so? And any change to our forecast for Indonesia rate this year?
Yeah, so BI seems to be in no rush to hike. In fact, in last week's policy meeting, Governor Perry stated that there's no rush to raise the policy rate because inflation stays manageable thanks to government subsidies. Recall that the government had earlier raised energy subsidies very significantly by around 350 trillion rupiah. That's nearly 2% of GDP. In order to keep prices of subsidized fuel unchanged. This has kept core inflation under control at around 2.6%. So previously, BI used to keep track of headline CPI and to ensure that it didn't go beyond its target range of 2 to 4%. But this year, they seem to be tracking more on core inflation, which excludes the volatile food and government-administered prices. The decision to hold will also support economic growth amid rising external pressures like stagflation risks. Another factor that's in favor for Indonesia is the healthy current account surplus. They expect the surplus to continue in the second quarter because of healthy exports of commodities like coal, steel, and metal ore. And foreign reserves are pretty stable at 136 billion as of end May. So the governor did highlight that there's sufficient reserves in order to support the currency. We still maintain our view for a 75 bips hike this year. We expect the first rate hike in the next meeting on the 21st of July. Given that accelerated rate hikes by the Fed as well as the ECB may further weigh on the rupiah in the coming months. Also, prices of major commodities like coal is peaking, and palm oil prices have erased the gains from 2022.
Thanks, Joey. I will move to Desmond on Malaysia banks. Desmond, I think Malaysia, BNM, many central banks, has started the tightening cycle already in May and is expected to hike more going forward. How is this going to affect Malaysia banks, especially on earnings and margins?
Yeah, morning. So in the short term, interest rate hikes generally have a positive short-term impact on banks' interest margins. This is because of the timing lag between loan yields and funding costs itself. So in the immediate term, we expect to see higher loan yields on variable rate loans and higher bond yields per se as interest rates go up. Funding costs, on the other hand, take on average about 3 to 6 months to normalize, this being the common duration of fixed deposits in the system itself. Our earnings currently factor in the one rate hike that we saw in May. And if we were to factor in the further rate hikes expected this year and next, we see further upside of 1 to 3% to earnings this year and a 2 to 5% earnings increase in 2023. The main beneficiaries we think will be Alliance Bank, AMMB and RHB. ROE is also expected to expand by about 0.2 percentage points this year and 0.3 percentage points in FY23. What is positive is that if we factor in all the rate hikes, then most banks should see ROEs return to more than 10% in FY23 as a result of the expansion in NIMs. So for now, we are maintaining our earnings forecast, but there is upside to our earnings estimates.
Do you think asset quality will be an issue given the higher borrowing costs, especially for loans that are still under the repayment assistance?
This is certainly an aspect that we are wary of, particularly as inflationary pressures are also likely to dampen and affect consumption patterns as a whole. However, with banks having set aside preemptive provisions over the past 2 years, we believe that the banks have set aside sufficient provisions to buffer against such an eventuality. In fact, based on our sensitivity analysis, we find that current preemptive provisions and regulatory reserves levels are sufficient to cover up to a 20% default on current repayment assistance loans, when actual default rates are currently less than 5% at this stage. So there is still much room for provisions to buffer against further asset quality deterioration arising from higher interest rates if the need arises.
Thanks, Desmond. We'll move to Rachel on Philippines Bank. Rachel, you wrote a report on the digitization of Philippines banking sector. And it is interesting that the number of total bank population, that means those with a bank account, has almost doubled within the past 2 years. And the e-payment penetration rate has also increased. Can you walk us through your findings?
Hi, good morning. Sure. So for the Philippines, it has indeed seen tremendous growth in account ownership during the past 2 years in the pandemic, with account ownership rising from just 29% in 2019 to now over 70% based on our estimates. So based on the BSP's latest data, majority or about greater than 80% of additions are e-wallet subscribers. Hence, there still exists a big market to tap for the basic deposit accounts and eventually turn these clients to borrowers. Excluding the e-wallets, though, account holders from financial institutions only account for 27% of the population. So the steady increase in the number of bank Filipinos should translate to more transaction-based fees and growth in CASA deposits over the long term, boding well for banks. So the rise in e-wallet subscribers should also be positive for banks. E-wallet platforms drive cash-in, cash-out transactions and partnerships for cross-selling banking and investment products. So meanwhile, yes, also the Philippines has been seeing rising adoption in digital payments, which has been the BSP's long-standing target for the country. So latest data from the BSP, however, is just for 2020, though this is still a good indicator of how we're progressing, mainly since we saw 6 percentage points growth in digital payment volume to 20% in just 1 year's time during the pandemic. So digitalization is a driver for fee income growth. In 2021, banks under coverage saw average growth of 30%, driven by transaction volumes, resurgence of fees for fund transfer, and of course, rising digital fees. Moreover, we expect banks to show decline in costs as they no longer pursue branch expansions. So I stop there.
Which banks are your top picks?
Okay, so for the banking sector, BDO remains to be our top pick as it complements its digital initiatives with physical expansion in the rural areas, thereby expanding the market. Its scale also enables it to grow loans and CASA faster than its peers. For our digital plays, we like BPI and Union Bank. BPI mainly due to higher income from digital products and lower costs moving forward, and Union Bank given its first mover advantage in the space, which allows it to now monetize on its projects.
Thanks, Rachel. We'll move to Anand. Anand, on ASEAN equity strategy, can you share the key developments and any major changes in our equity recommendation for the region?
Yeah, hi, good morning, Winson. Good morning, everyone. If you look at the last 2 weeks of performance for ASEAN, it has given back a lot of the outperformance it has had year to date, I guess in parallel with a lot of developed markets as well, following the Fed rate hike. I think what's a little bit different in ASEAN among clients right now is this feeling that, we're a little bit behind the curve in terms of the main issues facing markets like inflation, interest rates, and of course, recession risk. And, ASEAN is now playing catch up. We are raising our interest rate forecast. We are raising our inflation forecast. And what will follow next, quite naturally to many clients, is GDP downgrades and corporate earnings downgrades. The main headwinds with that, we're already seeing margin pressures coming through from higher input costs, higher labor costs. Recession risk also will cause earnings to be revised lower. And now you have this commodities price whiplash, where commodities are correcting very quickly. And that will, have certain implications for earnings, some negative for ASEAN as well. So I think, the mood in ASEAN now is increasingly defensive, where previously it was quite balanced. And clients are now looking for a more defensive sort of orientation to their portfolios.
Considering an increasingly challenging global macro environment, I think as you mentioned, higher interest rates and concern about the US recession risk, should investors go defensive?
Yes, it does appear that there should be a bigger defensive element in their portfolios. I mean, we were quite balanced in our view before, but given the realities, given the fact that we're going into an earnings downgrade cycle, where it will be very difficult for the market to rally into when earnings are being cut, it's only natural to be defensive. And this week, or in this edition at least, we have been upgrading some defensive sectors. In Thailand, we've initiated on the telco sector, and we are positive on that. And that's a classic defensive sector. The Philippines, we are reiterating our view that consumer staples are a good place to be in this current uncertain environment. And that's a defensive sector. And I think, we're also initiating on some of the more interesting value plays in the Philippines. We are initiating on the property sector through Wilcon and MREIT. And in Malaysia, we're upgrading some of the more defensive stocks like KPJ in the healthcare space. Again, another defensive sector we would recommend across ASEAN.
Thanks, Anand. We'll move to Jacqui on Philippines equity strategy. And Jacqui, you cut your 12-month stock index target for Philippines to 7,600. Why is it the case?
Hi, good morning. So our 7,612-month forward PSCI target is based on a 2022 to 2023 earnings growth of about 8% and 19% year-on-year respectively. This already factors the market's vulnerability to oil and inflation pressures. So this level implies a market PE of about 17.2 times, which is within the market's 10-year PE of 18 times, but still definitely a long ways away from the current 15 times that the market is trading at, positioning the Philippines definitely as a strong value play.
And which sectors do you think will outperform, and any sector you are more concerned about?
We are positive on the banks, property, and telco sectors, and selective on the conglomerates, consumer, and power and utility sectors. So the bank's loan books should benefit from increased economic activity, while their NIMs should get a boost from the rising rate environment, as about 70% of their exposure have floating rates. For property, excuse me, the country's sustained reopening trajectory should enable increased revenue recognition from the full swing of construction activities and the sustained demand for mid to high-end residential offerings, which the banks have also regained appetite for as well. For telcos, growth in the fixed line should hold strong, considering that the country is shifting to more hybrid and work and learning setups. Plus, there's also added potential from the telco's fintech initiatives. We are most lukewarm on the consumer sector. As an importer of key raw materials and the fuel and supply-based inflationary pressures, which consumer companies are unable to fully pass on to end consumers, are likely to create long-term margin pressures on that sector. So in terms of stock picks, we like SM Investments, Ayala Corp, and BDO, and we definitely recommend some exposure to yield plays such as PLDT, AREIT, and DMCI Holdings.
Thanks, Jacqui. We'll move to Han. Han, S&P 500 index is down 23% from its peak. Are we near the bottom yet? And in the report, you look at the market from many angles, such as the inflation trade, and you think quality to outperform in the next stage. What are your key findings?
Morning, Winson. Yeah, regarding whether the S&P 500 is already close to the bottom, of course, I think there's a few reasons that support a relief rally, which may be happening currently. Firstly, inflation expectations, as implied by the inflation break-even, 10-year US inflation break-even, has come down from its record high levels. And secondly, investors likely have already sold stocks before the biggest rate hike we seen 1-2 weeks ago. But whether or not this rally can turn into a more sustained rally, it will depend on how effective is the Fed interest rate hike in bringing down and also stabilizing inflation expectations, which will then provide more leeway for the Fed to balance growth risk and eventually to avoid a recession. So with the uncertainty in mind, we compare the current index level and also the valuation drawdown versus the past 3 recessions. And we find that based on the current index level and valuation drawdown, we can see further downside from here if recession materialize. But however, if US managed to avoid a recession, then the current valuation drawdown is actually very compelling. Compared to the US markets, we actually see Chinese stock markets as being much more likely to have already bottomed out in March this year, even if US does slip into recession later. On quality style, just to recap that we were positive on value, we are still positive on value since last year. And value tends to perform well under a high inflation environment, but then it performs best when growth is also highest. With the rising recession risk, we revisit this style performance under different kind of growth environments and accompanied with high inflation. And we see that when we move from a high growth environment to a medium growth environment, the attractiveness of the value strategy fall relatively, and it improved quite substantially for quality. And another reason we like quality is also because it has basically suffered the worst performance against value over the past 1 to 2 years. And this is mainly caused by indiscriminate selling of stocks with high valuations as a rotation into value. And as a result, the valuation of quality has dropped by about 30%, which makes it very attractive. And lastly, another finding is that similarly, we look at sector performance under different kind of growth environments and high inflation environment. And we see that energy even though it is still likely to outperform when we move from high to medium growth, but it becomes relatively less attractive. And another finding is that as similar to what Anand has mentioned previously on defensive sectors, we see that the data also support when we move from a high growth environment to medium growth environment, the defensive sectors become much more attractive. For example, consumer staples and also healthcare.
Thanks, Han. We'll move to TJ. TJ, on Malaysia automotive sector, there's no more extension for the SST holiday. How will this affect the sector?
Hi, Vincent. Basically, we are relatively mixed on this outcome, on this policy. First of all, bookings made by end of this month, 30th of June, will still enjoy SST holidays. And the franchise holders are given ample time to deliver these bookings up to March 2023, which is a 9-month grace period. But on the other hand, it will also prove to be a distraction and disrupt the operations of the automotive industries. Why? First of all, it will create much speculative bookings and unnecessary cancellations up to March 2023. Consumers can take advantage from all these bookings with SST exemptions, place token deposits just to lock in bookings by 30th of June, and they can cancel or transfer all these bookings. And if they decide to cancel their deposits, the token deposit will be fully refunded. And this will basically affect the operations, bookings, and production of the automotive industries until March 2023. Another disruption that we think that would likely happen is basically for the time-sensitive or price and time-sensitive car purchases. Some may basically place bookings now, but will seek to take delivery of those cars by 2023 first quarter for value purposes. Some may like a manufacturing date of 2023 versus 2022. And this will basically again affect sales and productions for the second half of this year. And if you were to look at this reinstatement of SST, we think that it will affect the national marks more than the non-national marks, given the fact that they are the price-sensitive A and B segments, and the increase in the reinstatement of SST will be more prominent on national cars versus non-national.
And you are still positive on the sector. What are the key rationales?
I think for the auto sectors, we are looking at a very strong replacement cycle, especially post-COVID. There will be many new model launches after July 2022, and with the global supply chips easing up, I think there will be more deliveries of new cars, especially the electric vehicles, taking advantage of the zero taxes.
Thanks, TJ, and thanks everyone for joining the call. Have a good week.
Get specific advice from your trading rep and check out market insights on the Maybank Trade app. I'm Noelle Lim on ASEAN Speaks by Maybank.